Hi friends, want to be a value investor? I can make you one just like this person, and this person. You will also become a value investor. Very simply, we'll use a tool called PE ratio. This financial ratio can find if company is too much undervalued or too much overvalued. All we need to do is find a stock under PE 10, market cap under 5,000 crores, and voila! You can put all your savings into these companies.
The promoters left.
No, it's
सर इसकी सेल्स तो डिप हो रही है कंपनीज की
fundamental.
फंडामेंटल से क्लियर नहीं है कंपनी के
I think, let me get back to you. Where'd this guy go? Clearly, something was wrong with that pitch. How can one single ratio, the P ratio, decide whether a stock is a value stock or not? And can you really become a value investor? Actually, everyone thinks the P ratio is a great way to find a stock. And we'll de-influence P ratio in this episode. We're gonna talk about the good, the bad, because clearly these guys won't tell you. We're gonna give you a checklist, so watch this video till the end. The most important tool any investor has is looking at the earnings of a company. Of course, there are a lot of other metrics, but earnings is really, really important. Now, I want you to go back 50, 60 years and think about the nature of earnings and companies which were listed. Think about a good company a couple decades back. It could be, say, a railroad company going and providing logistics and supplying stuff throughout America. And this is a very good example because you could sort of predict where and how much money this company could make. Now, could this company become 10x, 20x in a single year in terms of earnings? Probably not. It's a little more predictable and you know its boundaries. But think about the companies which are listing nowadays in India. A lot of them are high-tech growth companies. Actually, even in the NASDAQ, you get similar companies where a company could become 5x or 10x in a single year, because technology has leverage and humans are using that leverage. So the nature of growth, that means the nature of earnings, which means the nature of price to earnings is also changing. So with that context, let's start with the first myth, is that you can pick any low PE stock. It's kind of funny. Agar PE low hai, it might be good and you trust that PE number. This is the first problem. So to illustrate, I have an actual example over here. Let's look at any P&L of any company. So after going through all of this filtration process, I'm calling it filtration, you come with the final number, which is your profit after tax. And it's from this number that we derive our P ratio. Interesting. Which means if any of these numbers above change, the P ratio changes a lot. Make sense? Make sense? So let's see a real example. Over here, its P ratio is 19, which was the lowest amongst all the other companies. So it seemed like a good pick. Now let's look at the P&L. Here you'll see revenue from operations is 0. That's not a printing mistake. It's actually 0. Then we'll see there is other income over here. And if you scroll right down, you'll notice exceptional items of 97,162. The number is in lakhs, so this is basically 971 crores roughly. And you'll notice at the end, they actually show a profit. Now, any normal investor would look at the P ratio, see it's made a profit and assume it's great. But this could be because they sold a land parcel or something else that's not core to the business. Take a minute to think about this. This business has 0 revenue, has shown a profit from other income, and its P ratio is 19. Can you trust the P ratio? The problem is not with the company. It's a listed entity and has given all the information, disclosed it as per law. The problem is you. You did not check. So don't trust that P ratio without looking at the financials of how the company earned that year. Myth number 2, you can apply P ratio to any sector. Okay guys, every sector has its own ratio and P ratio may not apply. Let's see an example like a high technology growth sector. So what I'll do is I'll show you a real company over here. Obviously, I'll remove the name and we can see over here that this company year on year is net profit minus 63, minus 1, minus 59, so on and so forth. So it doesn't seem like a good company if you just look at the net profit, and obviously there is no P ratio because there is no profit. But if you look up and look at its sales, you can see that the sales sometimes does 100% growth. So this company is probably sacrificing a net profit for a high growth because it thinks there is a big market to capture in a short period of time of 5 to 10 years. You can also find this in companies like Amazon, which are famous for not making money for a really long period of time to capture a really large market, and its stock price looks like this. Now, does this mean that the P ratio can be used in companies like this? No, you'll have to find a different kind of analysis. One ratio would probably be price to sales. If you're a high growth company, then okay, are you doing high growth in sales or not? I'm not saying buy or sell this company, but the simple thing of applying a P ratio in any sector doesn't make sense. Another interesting sector is the biotech and pharma sector. There's a lot of effort because a medicine can take a life, so it has to be tested properly. And take a look at this company over here. Found this very interesting. In fact, I've never seen this in my life. This came out while we were researching for this. And you can see that this company has expenses like any company, but there's a line item over here that says clinical trial expenses and product development right here. Isn't this so high? This company's sole job is to do research and development of drugs. So it's expected not to make high sales and high profit every single year. It finds this one drug and that does well, and it supplies it to its mother company, whose job is to produce high sales growth over a period of time. So applying a P ratio on this kind of company will make no sense. And one more example is a capital intensive industry. This could be anything from the guys making the metro to a fashion retailer which is manufacturing all its clothes. Take a look at one such example here, where the sales growth is from 1800 crores all the way to 11,000 crores. You can see the operating expenses is nice. The operating profit is also fairly decent. But then come two line items which are the largest expense. The first is depreciation and the next is interest. This means this company is capital intensive. It's probably buying a lot of machines and showing the depreciation over here like it should, and therefore the net profit actually becomes minus or really, really low. So looking at a P ratio over here may not make sense. A better metric is probably looking at EV to EBITDA, because the EBITDA actually is before depreciation, doesn't account for that non-cash loss happening. My point is simple. Every industry needs a different way of looking at it, a different way of looking at the metrics. You can't just say P ratio badhiya hai, I'll use P ratio on any sector. The third myth is that you can use the P ratio at any given point of time. You see, just like the economy goes through booms and bust cycles, so does a business. And you can see that in its earnings. So if you look at, say, this company over here, this is real data, by the way. I've removed the name of the company. And this is the earnings of that company in EPS, of course. You can see at a certain time, it is at high earnings, then that earnings becomes negative, then becomes high again, negative. Notice that period is quite cyclical. It's almost the same, right? Which means it goes through a cycle, and this cycle is happening every 2 years or so. So there is some kind of cadence. Now, what's interesting is that if you know a business is cyclical, then when you look at P, suddenly everything changes. Over here, you can notice when the earnings goes down, the P ratio goes really high. And maybe at this point of time, you'll think, I should not invest in this company. The P ratio is very high. But the truth is, when the earnings go up, that's when the price also spikes, and you completely miss that. So if you're trying to time the market by trying to buy low PE, you'll completely miss the cycle, because when earnings go down, P ratio becomes high. Then when earnings go up, P ratio does the opposite. My point is very simple. Don't try to time the market just by looking at PE ratio, especially if it's a cyclical company. Myth number 4, you can compare PE ratios within an industry. I know that sounds shocking. The first thing you do is compare PE ratios within the industry between the companies. Now this is fine, but there's one nuance that all of us forget, and that is this. Let's suppose we have company 1 and we have company 2. Both are from the same exact industry. But company one's growth is exponential for whatever reason, and company's two growth is also growing but slightly slower. So the P ratio for this one is likely to be higher, let's say 25. But for a company like this, in comparison, the P ratio is likely to be lower. Let's say something like 11. Now the reason this is because this is high growth and this is lower growth. And the market, the people participating in it, price the PE ratio accordingly. Now remember, what is PE ratio? It's a multiple of the current earnings. So if the market thinks that the earnings will continue to grow, then they'll be okay with paying for a premium, which is why you see high growth companies which are profitable always at a high P ratio. They'll never be trading really, really low unless a cataclysmic event happens over a short period of time. Usually they'll always be trading at a high P ratio. And this is completely fine. It's just reflecting growth. The second aspect is risk. And based on high or lower risk, this P ratio again goes higher or lower. So think about what could be risky for a business. One could be, say, leverage. Let's say that they have high debt. So I can say debt is high. If that happens, that increases the risk. Therefore, the P ratio becomes lower. Another could be just management. I'll write MGMT. Maybe the management left, maybe the management isn't good, maybe there were false promises. All these things add to risk and the P ratio reduces. Point is very simple. Don't look at PE as a blanket to compare two companies, even if it's in the same exact business, because these things are company specific. And here is a final checklist. I know you didn't watch the video and you skipped to the checklist, you cheater. But if you did do that, please go back and watch the video. But let's come to the checklist. First, some industries are cyclical, so use that P ratio carefully. Second, find out whether this is a high growth company and what's the risk. Based on that, the P ratio could go up and down. Third, be wary of earnings manipulation. Is that net profit actually true, or was there other income and other things that affected it? Look over the last few years to see whether the numbers make sense or not. Don't just believe in the PE ratio. Also know that PE ratio alone will not work. You'll have to look at a bunch of other metrics to find and become a value investor. And finally, we have Nifty 50. This is my personal bias. I think looking at Nifty 50's PE ratio gives you a fair idea whether the market is currently fairly valued, overvalued, or undervalued. One problem here might be is that Nifty 50 is weighted, which means that the top 10 stocks take away a lot of this versus the last 10 stocks. But still, it's a good way to know whether generally the market is in overvaluation or undervaluation zone, and perhaps looking at this will help you. And the last point, that PE ratio cannot be used in all industries, but work really well where there's some predictable earnings. So generally, old businesses, right? Known businesses like FMCG, IT, paints, where there is some predictable earnings, it works pretty well over there. If I missed something in the checklist, put it in the comments below. If you like this, say I love day influencing, tell me what other topics we should pick up. We've done a bunch of things before this. Check out our MLM scams that we did in day influencing. Check out this as well and watch them. Watch the entire playlist because bahut mehnat karke we've done a good job in doing this. But we need some encouragement. Put something in the comments, hit that like, hit that subscribe, and see you, you know what I'm gonna say, in the next video. Hi friends. Now you can't. कहाँ गया camera? ठीक है? This was Vasu ending. अच्छा क्या ना? Some people would have skipped.